general mutual fund is following a benchmark, would be Nifty 500 or any MSCI WI, okay, or any global index or any global uh, benchmark if they follow. But these alts are known for alpha generation, okay. These alts are known for diversification. In a mutual fund, we are seeing that mid cap, large cap, small cap, alt or this flexi cap or anything option is there. Then there is a specified cap within which fund manager need to make an investment or make a decision. This is not here in this case. This could be a thematic, this could be a VC, this could be of any theme, could be of AI, could be innovation as mentioned on the screen, could be unlisted companies, could be assets. When I say assets, it could be a investing in a real asset also, could be a investing in a gold or derivatives or kind of thing also. Uh, as this oh, 1 second. So as we can see, these alts having a generally two or three or four kind of strategies. Long short is one, arbitrage is another. Special situation wherein they are in the long short, there is a one term called 100 and 30. 130 and 30. So 130 is a long position in which people that fund manager will keep buy on a securities, and 30 would be a short position wherein fund manager do a short of that securities. In a long only option, that fund manager will believe in a value or believe in a growth, and by doing that, by following a strategy, they keep holding or keep buying such securities. uh, in arbitrage, it's something different. In special situation, they will generally focus or buy securities wherein there is a distressed securities. They are in the liquidation or in CIRP or anything else. Okay. This kind of alts would be there. We'll see all type of alts in the next slides. Okay. What is the risk involved in these alternatives? Which is first is illiquidity. These are the high at risk. Okay. Capital loss would be also there. To understand the alts, it's quite complex. Sometime we can see key person risk. There are many clause in alternatives which we had seen. There is a key person mentioned in a PPM, that this is the key person of these alternatives. And in a case if that key person stops being or not being associated with the entity at that level, fund will stop doing further investment, or also there is an option of liquidation also given to investors. So this kind of risk could be there. uh, regulatory and operation risk is at medium level. Some called as a leverage. So 1 second. Huh. So leverage is available for Cat 3 IF. So fund manager managing a Cat 3 IF can take a leverage and invest in complex strategies like option and derivatives and so and so forth, which is available to him. Leverage is available to Cat 1 and Cat 2, but only for their operational part, not for or liquidation or anything else, and not more than or beyond it. Uh, what we see as a challenge in a cat in all alternatives, apart to this risk landscape, the taxation is also a challenge for cat 1 and cat 2 as a pass through. But for cat 3, wherein there is a major chance to generate alpha, it's taxed at 42.74 at MMR. Sometime in a period or a scenario, we had seen a funding winter. When we say funding winter, that means that there is a no funding obtained during that period. Okay. So there was a question asked in our examination on the last week, that what was the funding impact in 2002 or 2008 would be there. Okay. So it was from 2022. So it was reduced from 22 billion to a 7 billion in a 1 year period. Okay. uh, we had seen a lock-in. So in generally closed-ended all AIF, there is a period of 3 to 7 years. So this is a challenge with AIF. So as we know, in India, we have defined AIF in three categories: category one, category two, and category three. Okay, the object of each category is a different. As we can see, Cat one is known for venture capital or SMEs or social ventures. Cat two is known for debt or private capital or somewhere on growth capitals also. Cat 3, which is a now trending kind of thing, which involves complex strategy or complex buying and selling of strategies, wherein fund manager having a leverage to buy, and also having a permission from regulations to have a leverage subject to a limits. And the generally the limits as in SEBI regs is a two time of NAV. So two time of NAV of this of investment, they can have a leverage. Okay. uh, for Hi Jimesh. One second. So as we see example, VC or angel or SME fund is example of Cat 1. Cat 2 be also known as a private equity or debt fund or buyout fund. We'll see in a future in a further chapter of management buyout or leverage buyout, and how the example of it is there, and which buyout has happened recently. In Cat 3, we had seen hedge fund, long short fund, or arbitrage fund. The structure of all these three categories would be similar: trust, LLP, or company. Uh, we are seeing it in further slides. Okay. So AIF is known for satellite rather than a core. Okay. So what does core mean? Core mean long-term discipline investment, which all general individuals. So as an individual, as an investor, we all follow a core strategy. Could be there could be might be a group of person in this call could be investing in AIFs, but we all follow a core strategy wherein we believe in long-term holdings. Okay, and by holding a long term, we'll earn something. That's we all believe. There is one approach called satellite approach, wherein people or fund manager or investor want to put their money in a riskiest scheme or riskiest theme. Like say for example, today could be AI theme. Okay, so if any investor putting on AI theme or green energy theme or energy or petrol kind of or this energy theme. And this is a satellite approach. So that was a question in our examination, that high growth opportunities at where at satellite or at core. Okay, so high growth is there at satellite approach. So we all are knowing that people who are taking high risk will have a higher return. Okay. So as we can see here, the three investors pooled in a one AIF, and that AIF could be a private equity, could be private debt, could be infrastructure. And the forms of AIF is trust, company, or LLP, or body corporate. It's allowed. So when we talk about private equity, it's invest could be a secondary or could be a primary private equity. Okay, which invest in equities of unlisted companies. When we talk about a private credit, it's providing leverage, or it's on a corporate bond. We had seen a category A category bond, or triple A or triple B category bond of Reliance or any else entity. Okay, these are floating in the market. So this method is called private credit. Venture capital, wherein people will invest in a startup or a venture which is having a less than 10 years of age. And this venture capital is promoting entrepreneurial ecosystem. We had seen a GVFL is known venture capitalist firm in Gujarat at least. Okay, there is a hedge strategy. Okay, as we are seeing a dollar and INR is keep fluctuating nowadays. Also, if I want to pay a 100 or 10 million USD at the end of 4 months from now, I can lock my USD rate by putting hedging, and by doing such strategy, there is a hedge fund. So in 1949, Alfred Winslow Jones had launched first hedge fund. That was also the question in our examination. Okay, this kind of MCQ question, if it come to my side, we'll put it on screen, which also help us to gain some score also, and we are getting knowledge. Um, uh, s- Special Situation Fund, which is known for a distressed company or CIRP companies. So if any company had filed for their bankruptcy or insolvency proceeding, Situation Fund will do an investment over there. This so there are certain limits on concentration limits in all such categories. Not have more than 10% of in one company, or 25% or such in one sector. But in this case, it's not applicable. They could be around 100% in one company focus. The another is a real estate. Okay, in real estate could be a REITs, or could be infrastructure project wherein the underlying asset is infra or real estate or company. 1 second. So by pulling AIF, whosoever are getting benefits, we can start with innovation sector. So if fintech or green energy or AI start pulling the money from banks, they end up paying loans and end up paying interest on the loan. The similar way could be for startup and private credit. So this kind of AIFs are available in the market, wherein they support this all ecosystem. Let's say startup, SME, infra, real estate, or stress asset. Okay, so this AIF helps to connect capital with opportunities. So there is one landmark private equity deal which happened in India, which is mentioned in our workbook also. So workbook Pincus investment, they made investment in Bharti Televentures, and it was a success. It was known as a first successful private equity transaction of around USD 292 million in 2002 area. Okay, we have on a screen this all this growth of AIFs, how this AIF had grown. As we earlier mentioned, so industrial revolution in India, when it's known as also known as LPG. Okay, liberalization, privatization, and government or degovernmentation. Okay, what happened in 1991. So that prior to that, on a global scale, it was happened around 50 years back. Okay, on 1940 to 50, the industrial revolution was happened in UK, driven by wealthy individuals and bank from UK. Okay, going further, VC was emerged in 1950 and 1960s. Okay, wherein that dot-com bust was happened in 2001, and thereafter thereafter this hedge fund which we had seen, the first hedge fund by 19 in 1949. Okay, and we all had heard or faced, or our father had faced the heat of 2008 crisis. Okay, wherein this AMFD, which is a regulator in Luxembourg or for Europe, they had came up with the regulations as to regulate this AIF segment. And as we are discussing nowadays in Gift City, saying that IFSCA is a managing a fund manager instead of managing funds, but this was there in 2008 with AMFD. So AMFD since 2008, they are managing a fund manager rather than focusing their bust on the funds. Okay, in India, 1996, by introduction of SEBI Venture Capital Funds regulations, it was started, and institutionalized private capital and unlisted companies investment was started from 1996, and in 2012 we had seen EIF regulations coming with. So by AIF regulations 2012 had changed shift from this investor friendly or manager friendly to a compliance burden, compliance lens kind of thing. Okay, wherein they have mentioned or they have mandated later on having AIF units in demand or PPM audit once a year, or kind of requirements on AIF fund managers was there in 2012. Okay, so regs on AIF in SEBI came in 2020, 2012. In Gift City itself, we all are knowing and witnessing it. After 2022 and 2025, this regs evolved, and we had we from IFSC, and we all are from India, are seeing a traction in a cross-border. Let's take example of inbound funds. We have around multiple inbound feeders in Gift City, which feeds into India, being a FPI vehicle, and we had started with outbound funds starting from I can figure out around 6 or 7 outbound fund is there, and more than 10 or 12. I am knowing the fund managers who had applied or who are in the process to file their offer document for outbound fund to have a global or to have a US or to have a China to have an emerging market allocation. So this gift IFSC framework also had evolved by this time. Okay, so these two landmark development which mentioned at the bottom of this screen, which is a Bharti Warburg Pincus in Bharti Televentures and KKR buyouts on of Flexitronics was there in our examination. Okay, so as we see here, this AIF ecosystem had grown from manager friendly to compliance centric. That also ask AIF to opt or to adopt a stewardship code. Okay, wherein stewardship code is meant or mean for uh, fund manager to take a active participation in the decision making of listed securities. So for example of any meeting or any AGM or EGM of listed companies happening, then they should be aware, they should be participate in voting, they should be having a keep active track on a management or on all such calls, quarterly calls, which is there from in compliance with SEBI listing regs or SEBI LODR. This is a compulsion put on by SEBI on AIFs. Okay, they also came up with a scores and ODR platform wherein investor is having grievance. They can raise their grievance in AIF through scores portal or through online dispute resolution portal. This kind of investor friendly also initiative was investor protecting initiative also taken by SEBI. Okay, so we had seen AIFs. So in AIF there is a two kind of pool available, which we understand from any category of or AIF or generally in traditional mutual fund and AIF. There is which what
Physical.
differentiate is that in traditional mutual fund there is a blind pool. Okay, the pool is available, all person will make a investment through SIP or through lump sum, and that investment manager or fund manager will make an investment decision according to his investment policy or his availability of stocks. Okay, but in the case of AIF, we can also be commitment and contribution amount could be a different. Okay, so we can have a commitment of 3 million, and we can have a drawdown, we can have multiple drawdowns. Okay, so this kind of nuance is there as available in AIFs. Okay, so what we can see here is that the traditional investment which we generally do in mutual fund or PMS is how this is a different from AIF. As we all know, AIF is a highly illiquid. Okay, but as well as mutual fund or PMS is a liquid. Even though in PMS, in case of other than discretionary PMS, the units lies in our own account, in our own demat account. Okay, it's not going anywhere from our account to fund manager's account. Okay, at minimum ticket size, if we talk about AIFs, if we talk about AIFs in mainland, it's a 1 CR. It's, if we talk about venture capital or Cat 2 AIF, in GIFT it is $250,000. Okay, if we talk about Cat 3 AIF or any else restricted scheme AIF, in GIFT it is $150,000. So the minimum ticket size for PMS for mutual fund could be a low, medium, or somewhat higher could be of PMS, and at a top could be of AIF. Um, Leverage kind of facility, which is not there in mutual fund, apart to a redemption or operational payment. Okay, in PMS, it's depend on the power of attorney, or how the PMS is working. But in PMS, if the PMS manager is trading in derivatives, then they should have some consent kind of thing from the investors. Okay, but for AIFs in Cat 3 AIF, the leverage is allowed. Okay, two time of NAV we can do a leverage. Okay, uh, uh, we can also see a suitability discuss also. The AIF is suitable to a person who is looking for satellite exposure, satellite or high risk exposure kind of thing. The one question which was there on the examination, which I marked on a right hand side of a screen, this is a hallmark trade-off. Okay, so hallmark trade-off means there is a less liquidity. In liquidity, there is a least liquidity in AIFs, which we had seen. Okay, so gradually, when SEBI had grown from 2012 to 2022, they become light touch to compliance intensive. Okay, they had minimum amount of 1 crore. Maximum number of investors which can invest in one AIF is 1,000. Okay, all units should be compulsory in dematerialized mode. Appointment of compliance officer also was mandated by SEBI. And for valuation part, okay, they came up with a valuation approach. Okay, before of that, there was no such valuation available there in AIF for performance metrics. Okay, so when we perform our long term or our HDFC or any stock or any mutual fund which we are having, we have a benchmark, or we have CAGR. Okay, we are knowing this return, what return we had on, or how to measure this AIF is moving in correct direction or not. As we all know, uh, while AIF, at initial level of AIF, when we start pulling the money, there is a huge expense of setting up. Okay, there is a huge expense of paying, of setup cost or management fees, or initially could be called as vintage years. The We don't that fund manager will don't earn more, they start losing more. Okay, so that effect is called J curve effect. Okay, so this J curve effect is because at initial level there is a management fees and setup cost before a value is realized. In some of the cases where is drawdown is a pending. Okay, or 100% pool is not taken off by the fund manager. In a Cat 1 and Cat 2, as far as I can recall, management fees would be charged on the commitment amount, commitment raised amount. Okay, in Cat 3 it would charge on investment or contribution amount which was raised. Okay, and so could be a higher side for initial years, as we haven't raised full commitment, but we have to pay management fees on a higher commitment. We haven't raised full contribution, but we have to pay a fees on a higher commitment. So this is there. um, so in one more thing is there is a IRR. Okay, so in AIF there is internal rate of return. So how complex, or how the fund is having good or bad, we can do it or imagine by by having IRR. So at on right side we have this three terminologies which is called DPI, RVPI, and TVPI. Okay, so let's understand the first. This is a DPI. Okay, so what's a DPI mean? So in a AIF, the AIF also make a distribution of income raised. Okay, in general, Cat 2 AIF, we had seen a practice of having a coupon. Okay, so that they start doing a distribution of realized return to the investors. So by doing that, by seeing that distributions, okay, we can also measure a return of fund. There is RVPI, which is a residual value paid in capital. Okay, so in some of the EIFs, they start paying out capital also going further, and the whatever amount remains, okay, whatever amount residue in that EIF is measured through RVPI and TVPI, which is just simple thing, sum of DPI and RVPI. So realized and unrealized value, uh, uh, considering as a holistic view, and we can consider that value as a performance metric to measure our investment. Uh, in terms of risk, we can compare on a benchmark. We can see a deviation or tracking error from benchmark. Okay, so if I am investing in ETF having a higher tracking error, or in negative, or in negative terms, then we can see that there is a ETF, that benchmark is performing well, but my ETF is not performing well. Okay, so for this EIF, what's there to measure the risk matrix? Okay, the one is called as a maximum drawdown. Okay, uh, which means from that let's take example, this EIF had started at NAV of $100, and it having a peak of 150, and from that it came through at came at 95. Okay, so peak to through decline in the fund value is is a is a is a risk factor, or is a measure to have a risk in a in any condition, or any market stress, or any portion of a market. Another is a VAR, value at risk. Okay, which quantifies, or which judge the maximum loss, how much maximum loss can this fund can occur in a defined timeline. So this is a calculated VAR. Alpha, we all know, excess return, how we can generate excess return, or how much excess return is generated versus a benchmark. So in example, for a 1 year period, if benchmark had generated 10% return, and this EIF had generated 12% return, that is 2% is a excess, which is 2% is the alpha of the EIF. One more is mentioned as skewness. Okay, so in a skewness, as I understood from the reading of this material, that skewness is saying that in certain fund managers will do a certain transaction. Okay, let's say example, that fund manager had did 50 trades. In 40 trades, they made a loss of $5 at each trade, but in the remaining 10 trades, they had made a 20 to $40 gain in each trade. Okay, so this is measured as a skewness, having a more frequent loss, but occasionally, or having a small but a huge profit. Okay, so this is measured in this way. uh, Kurtosis. Okay, I don't know how to pronounce this. Okay, but this was there in the examination as a fat tails. So they are also known as a fat tails. Okay, so uh, in a extreme event, or in an extreme condition, how this fund can deviate, uh, uh, can deviate from the benchmark is measured here. Okay, second here. So 1 second. something I missed here. Okay, so in so as we can see here on the screen, AIF's benchmark or AIF risk measurement thing is not simple or not defined or not known in a regs or anywhere in these rules that this is the correct measure to value a risk or to identify a risk or to value the fund. This keep changing on fund to fund or category to category. Okay, so in these three categories of AIF, there could be there could be a different kind of measures which we can take it to measure a risk or to measure returns. There is example mentioned here. I think we have covered this. Let's skip it. Okay. So we'll start with Cat 1, as we all are basically knowing that Cat 1 AIF is a mint or a structured for a startup or early stage ventures. Okay, and wherein the Cat 1 AIF is focusing uh, to beneficiaries to have a private capital or to have their own startup or to have their own equities by putting some support, and after a certain period of time while having a listing or while having a buyouts, this VC fund will leave this cat 1 AIF. Okay, so there is a cat examples of cat 1 AIF: VC fund, angel fund, infra, SME or SSF, or social impact fund or SME funds, which is covered in category 1 AIF. The question was there in exam that SSF is which fall under which category. So the correct answer would be category 1 AIF. We sometimes feel that it's a special situation, could be cat 3, but it's not the correct answer. The correct answer is SSF is generally close-ended fund. Okay, which focus on distressed securities or securities which are in a liquidation or at CIRP stage, wherein fund manager will invest in those securities and try to generate alpha or try to generate return from investment on those securities. Okay, so cat 2 AIF, now in India, we had seen evolution of cat 2 AIF. We had seen huge chunk of money coming in cat 2 AIF. At least at my entity, I had seen
हम्म,
one cat 2 AIF launch around in a 1.5 year period. Okay,
अनपढ़ भी होगा ऐसे.
this is known
हम्म,
for private equity, private debt. Okay, wherein this entities getting support of equity or debt at a compatible rate. Okay, at a lower rate than banks can offer, and this institute also will have a good option to have have a income or fixed income kind of thing. Okay, 1 second. So there is a logic. 1 second. Cat 3F. We'll come back on this slide. Okay, so Cat 3F, which is known for their leverage or complex strategy per se. Okay, so these are long short or market neutral. So when we say long short, in that mean that there is a in one security they have 130% long and 30% short on the same security. Okay, could be long only, wherein this just buying will not keep sale. Market neutral, wherein the direction in any direction market fluctuate, it's come at zero or at a positive in for at cat 3 level. Okay, global macro, private investment in public equity, also, and a derivative base. Will come back on this slide again. Okay, so how this function. Okay, how this AIF is known. So we can just say simply way, for early stage or for early stage growth, or for early stage we can see it's a cat 1 AIF. Okay, which we can also known as a series A and B. Okay, for growth or going further, when you're looking for a growth capital, so you had started your business but now you are looking for a growth capital, you can go with series C, wherein wherein you can collect money through pre-IPO debt or pre-IPO launches in VC or secondary PE kind of thing. And Cat 3 is there as a secondaries market or private equity or hedge strategy or kind of thing. So for academic and for exam purpose, we can remember this, that series A and B could be covered in Cat 1 AIF, and Series C, which is called as a growth capital, is covered in Cat 2 AIF, and what's the remaining secondaries market or private equity, private investment public equity, is covered in Cat 3 AIF. So how this AIF works, we are tried to mention here. So starting from a deal sourcing, that yes, this is the equity or this is the company wherein we should invest, kind of a source came here, kind of NDA and signing off, and could be uh, starting from NDAs or non-binding letters of execution happen between that fund manager, investment manager, and the company. And then that fund will pool a money and do a investment. And then fortunately, if that fund manager works well, then they will create a value. And ultimately, if it's close ended, then there is a compulsory exit, and if it's open ended, then investor will do exit. Okay, so we can just try to understand that how the investment looks in a market. If we just do buy stocks without pulling, okay, we could have more stocks or more value in our bucket, but we'll not able to have a scale as the fund can do. Okay, so with pulling, we can have a larger value, larger pool, and can also diversification, and the most important thing, which is a professional management, professional skill. Okay, we don't we being a general individual, generally we don't have such a skill to read through script or to hold or to buy. Sometime we are loving a securities, we love data, but we should, instead of earning from data, we start loving data. Okay, I'm just mentioning securities as a give example only. So this kind of thing could be happen with us, but this feelingless or ruthless fund manager or investment manager who are there to generate alpha. They will generate alpha by accessing a deal or by accessing this professional management. So there are three structure commonly known in this AIF. Okay, the one is a trust, wherein the starting of this trust become with indenture of a trust, commonly known as a trust deed. Okay, so almost all AIFs, as I know in Gift City, could be 90% or 95% would be there in the trust structure. Okay, so we set up a trust, and trustee was also appointed, and trustee will take care of these compliance of registration of trust, and that trust will appoint investment manager and sign off an investment management agreement. And the fund which is pooled in the name of the trust is managed by the investment manager. Okay, what could be the one or two or three step, or why we all are following trust structure, knowingly or unknowingly. Okay, so I being unknowingly before reading this material, why we have opted for trust structure. I thought that could be LLP or LLP or company is not possible or not in our radar to have as an option. Okay, but trust structure is a known, because it's quite flexible, and there is only simple registration requirement, and there is a no such annual or half yearly or quarterly or any such compliance is there. Apart to it, there is a privacy, or we can say the one investor is not knowing to the another investor, and also not known to the regulator also. Okay, apart to this SEBI FPI compliance or any compliance with the regulator of the mainland. Okay, uh, we don't need to file the name of the investors with the registrar of trust, that whosoever are had invested or the beneficiaries of this trust. Okay, so this is a flexible, confidential. and also not in gift city. Okay, in India, we can float a multiple schemes in a single trust. We just need to have a one trust. Okay, Pringle Templeton Mutual Fund Trust having 35 or 36 schemes in a one trust. Okay, the same way also is there with HDFC or Mirai or Nippon or any else AMC. But uh, uh, at gift city we have challenge in GST and other perspective. That's why and SEZ also. So we create separate trust for a separate scheme. But in a mainland in DTA, there is a flexibility of multiple schemes in a single trust. Okay. uh, for LLP, there are a few funds who can also structure the LLP. There are two partners in this LLP. One could be a designated partners and one could be a investment partners. Designated partner could be appointing or could be a fund manager who is managing a fund, and all this payment of management fees of that fund manager is getting paid from that LLP structure at all. Okay, that could be we are digging out further in a future chapter, but just understanding purpose I'm saying here. So and but what constraint LLP has is that they need to so on every contribution or on every commitment or any contribution agreement, we need to inform a registrar of companies that this is my investor who had just onboarded with this amount, and partnership contribution agreement keep changing from here and there. Okay, the third one, which is a least common structure in India or in SEZ or in Gift City, which is a company. Uh, Fund could be in the name of company, can create a company, but the main drawback could be how we can uh, redeem a capital. Okay, which we are pulling from investors, or how there is in a private placement there's a 200 number of investors which we can invite through as a company that lands. Okay, but in IFSC or in CBRX it's allowed 100 or 1000 investor. Okay, so how will do this compliance? Could be how we can utilize the capital, or how we can pay back capital, if it's called as buyback or dividend or binding of a company, or so and so forth. So that's why corporate structure is a least preferred structure for any AF or for any scheme. So for any in government also, so we had seen a national infrastructure investment fund which invest in infra level. Nitin Gadkari's could be benefited from that AIF, but these are the cat 2 AIFs. Okay, these are the cat 2 AIF, but no structure in government fund also is having a LLP or company kind of structure. What we had seen is that only trust structure is a preferable or opted uh, opted by all the investment managers. Give me a second. Okay, so here key parties to AIF. So whoso all are required if I want to structure AIF, the person mentioned on a screen are the must required person. Start from a sponsor. A sponsor will come as a settler of the fund. Okay, will also bring some his own money. Okay, to this AIF vehicle. In Give City Rags, it's a different. We'll cover it in when we are covering the regulations part. But as we are covering this SEBI Rags here or AIFs in general, it's starting from 2.5% to 5 crore for Cat 1, Cat 2 AIF, and could be a 5% of corpus to a 10 crore in a cat 3 IF. Okay, so the settler or a person who is responsible for AIF, for forming AIF, will become a sponsor. Trustee, so the trustees are one who are looking for the investors. Okay, so in when we say investment manager looks for management fees. Okay, investment manager monitors investment. They also sometimes worried about alpha generation. Okay, because of some strategy or some hurdle rate, or some mentioning is there in the BPM, then they could be worried about the returns of the fund, but they could be more focused on their management fees only. Okay, but the trustees are the who are taking care of the rights of the investors. Okay, I just don't want to criticize the investment manager yet here. I am also belong to investment management company. As we had seen, if a fund will do a loss, investment management entity or FME or AMC keep having management fees of a certain percentage of AUM at any point of time. Okay, in a profit also, in a loss also, at break even also, they have some structured management fee which is defined in the PPM or for document of a fund or AIF. They are centric of that only. Okay, here some key service provider called as a custodian or registered transfer agent or fund administrators. Uh, One second. So they are the person who are responsible for their assigned part of work, and they will take care of those part. So let's take example of onboarding of investors. The RT will take care of it, and reports also will taken care of it. Administration part of accounting of fund or keeping a safe custody of the funds are taken care by the custodians or administrator. The another thing which here is a investment committee. So here investment committee comprise of a persons who are liable for investment decision. Okay, so this committee do a decision on investment. If any person who is outside of this investment committee, if they want to be a part of this investment committee of any meeting of the investment company, then there should be a 75% or more by value consent required from the all the shareholder or stakeholders to participate in this investment committee. This investment committee generally approves or reviews the investment decision taken care by investment manager. Okay, this also include investment manager also sometime. Uh, uh, there is one terminology, I think it's mentioned here or not. Okay. Yes, it's here. So at here, one second. Yes, all are covered. Yes. At here, how this flow from investor standpoint of view, the investor do a capital commitment or sign of the capital contribution agreement and commitment agreement, and start doing remittance as per the mentioned drawdowns. Okay, the manager start managing capital. If it's a close ended, and it's a period till which that money will invested. Okay, so in this AIF we had seen a first close and final close. Okay, so there was a question that MCU kind of question, that first close at how much amount we can say it is a first close. So in SEBI Rex it's closed, it's called at 20 crore. Okay, so when the any fund collect 20 crore as per SEBI Regs, they can start begin investment, and the final close would be at defined amount, which is mentioned in the PPM. Okay, so final close would be at that amount. But the first close, and there could be multiple close also. There could be a more than one close. If any cat 2 fund or any cat 1 fund they want to do, then they can manage such first and intermediary closes between the first and final closes. Okay, this is a portfolio monitoring. Valuation is at a periodic valuation. So we can see in further chapter wherein cat 1 and cat 2 AIF is having a valuation at the 6 months periodicity. Okay, wherein cat 3 could be having a monthly in case of open ended, and could be a quarterly in case of close ended. Okay, this is the valuation requirement. On exit could be a merger of this fund, or could be sale, or could be winding off of the fund, and whatsoever earnings is made by this fund is distributed with the investors. Okay. So one thing which is also called as dry powder. Okay, so let me yes, mention here. So while in a normal mutual fund or normal fund, there is a pool, blind pool available, wherein investment manager collect a fund and do a investment in underlying fund or underlying securities. While here in this AIF, commitment amount could be a higher, and then managers start drawing down when it's needed, when they think to have investment. Say for example, they have a commitment amount of 100 million with all such investor. They can start with investing 25 million, so they have a drawdown of first drawdown of 25 million, and going further they can start procuring 100 million as a full capital commitment. So that remaining 75 million, which is there as uncalled capital, or this would be called as a dry powder. Okay, this could be multiple MCQ question in examination. What is called as a dry powder? So committed capital, but uncalled capital is called as a dry powder. So and once all commitment is called, then this will start doing investment, and then it will having a realized earning, and then investment managers think to have a distribute, then they have a distributions, which we can see here on the right hand side of this diagram. So the return would be a lower or lesser in initial year, then it would be growing, and it coming as a distribution. So investment protection framework in all such AIF as per SEBI lens is a annual PPM audit, investor charter communication to the investor while having a signing of the contribution agreement. Okay, standard evaluation policy is there. On grievance part, there is a ODR and scores is available. We also discussed this thing initially also. For AIF constitution, how this constitute this trust deed or LLP agreement or MOA AOA will be taken care of. Then this would be then there would be a private placement memorandum which is covering all these key informations of the strategy. Okay, then and before a BPM, I could that system that there would be investment management agreement before filing a BPM. So investment manager is appointed, and he takes care of this investment management part, and the contribution agreement, which is signed between an investor, trustee, and investment management entity. Okay, and it also defines how this investment will flow, what are the key terms and condition, how much drawdown would be there, what if I will do default, what's there as a exit load, what there as a hurdle rate or anything else, or any performance fees is there, or any entry load is there, or anything and everything. If it is there, then it would be mentioned here. So and then last thing is investment charter, which is covering all this summarized version, which we are normally calling in MF as a KID. Okay, key information document kind of document is generated and given to the investor. So how my money called, managed and valued and reported and returned is we can understand from this constitution. There's a small glitch here. IMA could be a prior to PPM. We'll correct it. Okay. So how this govern here in AIF. Okay, so this is based on a people, process, controls and reporting. Okay, this is mentioned here, we can also discuss here. But as AIF constitute, this is a people driven. The KMP should be identified, compliance officer, investment committee is accountable, and key person, as we also discussed earlier. In some of the PPM they mentioned a key person, and also mentioned a key person risk. If certain fund manager is a key person defined, and this fund is based on the intelligence of or view of that key person only, in that there is a provision that in case of key person is not there anymore with entity, or uh, uh, then they can stop doing further investment, and they can also provide a way out wherein they can wherein the investor have a option to withdraw or to file a winding up of the fund. The process which is there for investor protection, which is quite simple. Annual PPM audit is there. Valuation process standardized in AIF. Conflict management is there. Stewardship code is a compulsory adoption for AIF. SEBI AIF, because in our IFSC zone, in our IFSC, stewardship code is voluntary, but it's not compulsory. Controls is there. So on control, we can say a major control is by custodian, or could be by custodian saying that in case of Cat 3 IF, there is a leverage mentioned in a ppm, and fund manager wants to do a leverage, then that leverage amount is reported to a custodian, and custodian on daily basis on custodian, and on a monthly basis that custodian will report that amount to the SEBI. Okay. In case of any breach, they need to recorrect or close that gap in certain period. uh, on a control side, yes, a trustee will have a control over a investment manager. Risk is unlimited, even it's mentioned as a limit, but it's unlimited. On cyber security part, the CSCRF, as we also have mandate to CSCRF, and AIF also having a such same mandate, okay, to have our cyber security framework in their fund. Okay. On the reporting part, the NAV disclosure is mentioned for Cat 1, Cat 2 on 6 months, for Cat 3 open-ended monthly, closed-ended quarterly, and also reporting of the underlying funds portfolio, also reporting of SOA, could be of investor charter also, and material events on immediate basis to the investors, and also on a grievance. If it's any grievance is there, then they can write to a SEBI, and they can also write to the investment manager. So if we try to summarize what we had talked in this 1 hour, then we can say that AIFs is what AIF is a private pool vehicle. There is a category, Cat 1, Cat 2, Cat 3. The structure could be a different for each category. The strategy or the investor base could be also different. Yes, this AIF is driven through a manager. Okay. And disclosure also is a different on open or closed or on a category of the funds. Okay. So this is what we discussed. Okay. Management. Okay, we'll try to cover this appendix AB in a next call. Okay, because I think it will take a time. So far we had covered chapter 1 to 6. If you want to do a revision